So I think these trade deals are extremely positive to economy, and there are several ways which overall economy gets impacted positively, and I see many areas where SBI is well positioned to take advantage of the emerging scenario. It is not only about corporate credit. Of course, corporates will definitely be impacted and benefited because of this. More importantly, the overhang of tariffs is removed now. There's a big positive. And number two is that the trade deals, both with the EU, Oman, New Zealand, and US, indicates that diversification of markets is available now for Indian corporates. But one thing what we also must remember that apart from corporates, a large number of MSMEs also will get benefited here. And if you see our numbers, I think we have had robust SME growth, both and robust rebound in the corporate credit growth. So we believe that these trade deals and the budget announcements are going to be extremely positive for credit growth point of view. Even if you have not asked, I would like to front run saying that we are going to revise our credit growth advisory from 12 to 14 to 13 to 15%. So this gives us confidence that the credit growth is going to be robust.
So my second question is on the SBIMF IPO. I wanted to get some sense on when can we expect a listing and when are you going to file papers for this IPO and so the valuation?
The boards of the shareholders as well as AMC board has approved 12-month period. That is, I think, up to September 26. We would definitely be reaching out to the market before that.
Okay.
Ms. Saloni Shukla from Economic Times, please.
Yeah. Good afternoon, sir. Just one clarity before I come to my question. So the highest ever net quarterly profit that you've posted, is it due to the Yes Bank share sale gain? Would that be a correct assumption or something else?
Yes Bank's the transaction that happened in the previous quarter.
Okay.
And we are not required to mark to market the current residual shareholding also. It is not coming from there. If you see, I think the profit growth has come from various levers, both, I hope that, we'll just show the presentation. Yes. If you can pull out the presentation, it has come from the fee-based income, recovery and return of accounts, and the net interest income, 9% growth rate.
Okay.
So all these factors have contributed. The operating income going up, operating expenses getting moderated, both have contributed to the. But if you really ask me, one-off item which is noteworthy here is the special dividend which we have received from SBI Mutual Fund.
Okay.
But even if you do not account for it, I think most of the levers have been functioning very well in terms of contributing to the profit growth.
Sir, on credit growth, especially, how much did you get from SBIMF?
2,200.
2,000. Okay.
2,000.
Okay. Sir, on the credit growth fund, especially on the retail side, most of the retail credit levers have seen much strong double-digit growth. Gold loans has, almost 100%. But on the express credit, it's around the 5 to 6% range, and even the NPA is around higher than 1%. So is there stress continuing, in that segment? When you had launched it, it was, extremely limited to a specific set of clientele. But now, what is the sense that you can give on that segment? Will you continue to grow it in that range?
So the express credit still continues to be addressed to the same segment. We have not moved away from that segment. It is still a salary package customers only. And the NPA level has actually come down quarter to quarter. And this is very, an unsecured personal loan, this is very small amount of percentage of NPAs. We wanted, probably we desired that, this particular product, which is very profitable product, should have a double-digit growth. But I think some movement is also happening to the gold loans. As I mentioned last quarter, it may not be significant that some of the people who would have otherwise taken the express credit, they believe that gold loan is a better option. you have low rate, and then you have a higher amount of loan available. So it's not big shift which is happening, but I think there could be some people, instead of availing the express credit, they are taking the gold loan.
Okay. And so one final question on pricing of, loan products. Private sector banks, are continuously raising this issue about tight pricing by public sector banks, and obviously the compensation on that front is the net interest margins. What would be your response to that? Do you believe that public sector banks are engaging into this lower margin products as compared to private sector banks?
No, I can't comment on all the public sector banks. Obviously, SBI has always stayed away from this. We believe that the pricing has to be risk-based. Risk has to be priced properly. And if you see that we have not compromised on our margins, we continue to project 3% NIM at this scale. And also have grown in corporate book. So I believe we are not in the game of or in the competition for, growing the book at any cost. We don't believe in that. And the growth rates, what we have witnessed in corporate book, is coming both from the higher utilization of working capital limits, which has nothing to do with the aggressive pricing, and also from a range of term loans. I don't think we are competing in any way in terms of the underpricing.
Thank you, sir.
Thank you. Next question we have from Hamsini of Money Control.
Hi, sir. Good afternoon. A couple of questions, but before I get more closer to Q3 results itself, I'd like to understand your last CD issuance in Jan, towards the end of Jan, was at around 6% rate. I mean, banks are really complaining that if SBI has to raise at 6, what happens to our cost structure? So what were the compelling factors for you to raise CDs at 6? Do you see this as a, do you see this as a normal new rate being set? And the reason I'm also wanting to press on this is probably for the first time you're acknowledging that financialization of savings is becoming a challenge on the deposits front, and there is a need to broad-based liability accretion. If you can address the rate.
No, first of all, Hamzani, this is not the first time I mentioned this financialization. For the last 15 months of my tenure, I've spoken about this.
But you've also said that, corporates come back to banks because ultimately the money will stay. The
money will still come back. Money will still come back. Corporates will come back. The household savings, the structure of household savings is changing. I think that we need to acknowledge. And obviously, wherever the savings are going, they have to come back to the markets. This is a limited point what I try to make. As far as in the process, I forgot your question. What was that?
6% CD, sir.
So, yeah, the CD, this is not the first time SBI has accessed the CD market. We have accessed in the market earlier also. The
rate, I think.
Yeah, the moment we realized that, this is not the rate for us, we stayed away from the market. So, eventually the market instruments have to be acceptable to us. Market pricing has to be acceptable. If you see, we have not accessed the market for tier 2 bonds when we realized that it's slightly elevated. So our resource mobilization is based on how we deploy them. We have opportunities to deploy, or at what cost we will be able to realize. But not not expecting SBI to access the market is not a right approach, right? The SBI will definitely access every market instrument which is available. But at a price point, which is acceptable to us and where we can deploy it meaningfully.
Your cost to income ratio has fallen to 48.4%. Is this sustainable? Do you foresee with higher digitalization, technology adoption, etc., the number coming to maybe 45 or so as we close in on FY27? Some guidance on that.
No, for the time being, we are not giving the lower number, but we are sticking to our guidance that we would like to keep cost to income ratio below 50.
Okay.
I think that guidance continues.